Melon Heads. Happy Tuesday. Morning live streams. Just doesn't get any better than this, folks. Anyways, I hope you guys are well. Hi, Mom. Hi, Dad. I love you guys. Hello to everybody in the chat. All those familiar faces. It's good to see you guys so early in the morning. Hope you guys are doing well. You're all doing better than Target today. That's a safe bet. Got quite a big warning from Target this morning. Looks like inflation has taken another bite out of the economy. Get into that in a little bit. Right now, futures looks like set to open pretty decent amount lower, a couple 100 points. Is this dead cat bounce over? Are we heading much lower from here? Well, let's take a look. Let's just shrink my big melon right away. Why don't we? Let's not beat around the bush here, folks. Right now, the S&P is set to open down 40 points, or just under 1% this morning. We'll come back to that chart. The Dow is set to open down 272, or about 0.8%. And I don't have my NASDAQ chart up. Looks like I forgot that one. It is the morning after all, and I'm not a morning person. NASDAQ set to open down 165 points, or 1.3%. NASDAQ leading the indices lower. That is where we should be in a rising rate environment because these big tech companies are vulnerable to rising interest rates. And hey, June 14th and 15th is the next FOMC meeting where we get another 50 basis point rate hike. Just want to remind you folks, that's still out there. And meanwhile, while we're talking about rates, the 10-year Treasury back over 3% this morning, 3.01, just under 3.01, although rates look like they want to head lower today. We'll see if that 3% level holds. But remember, there's another 50 basis points on the horizon. Stocks don't like those higher rates because we have a debt-based economy that is dependent on 50 years of easy money. That bird is coming home to roost, and these higher interest rates are not good for the U.S. economy. All right, let's take a look at commodities real quick, see what we have going on. Gold and silver pretty much flat for the day. Silver's down a couple of cents or 0.5%. Gold is up about $1. Looks like base metals are pretty much flat. Not a lot happening in commodity space right now. WTI is flat, down 17 cents, although pushing back at that 120 level. I talked about that in my stream on Friday. We're at 118 right now. Oil has been marching steadily higher. You know, we had that big run in March. I remember getting off the plane, seeing $134 a barrel. And, you know, we came down pretty hard after there. We've been releasing millions of barrels from the Strategic Petroleum Reserve every day. Not really having much effect, is it? Now we're back almost to 120. Keep an eye on those oil prices, folks. We'll look at the chart in a little bit. They are heading higher. And natural gas, my God, $9.47 per million BTUs for U.S. natural gas now. I don't know if you guys remember at the start of the year in January when it was freaking cold and everybody had their heat turned up and we were all shivering. Natural gas was like $3.30 or $3.40 per million BTU. We have almost tripled the price of the single most important heating fuel and electricity generating fuel in the country. That's going to also have reverberations through the whole economy. So remember, over the next few days, as all of these talking heads on CNBC, they keep talking about the peaking inflation, right? Inflation has peaked. It's largely peaking. We believe inflation is peaking. The Peking buffet. Forget it, folks. As long as energy keeps heading higher, everything is going to keep getting more expensive, all right? And Friday, we get our next CPI read. So either tomorrow or Thursday, I'll put out my CPI preview that I do every month, where we'll dig into some of the numbers that are, you know, what's happened in the big categories that have been driving the inflation narrative for the last year or so, and see what those prices have done over the last month. I'll have that coming out over the next few days. But look, I noticed this trend right now where retailers are getting crushed, and we'll talk about Target in a second. And that's driving down the price of a lot of durable goods and a lot of like retail products. But at the same time, the energy and the food situation is just absolutely squeezing the heck out of the consumer. So we're getting this bifurcation, I think, in the inflation numbers, where we're going to see core inflation start to come down. Now, core inflation is when they strip out volatile food and energy because people don't need to heat their homes or, you know, to eat, right? So we just take those out, just not count them. So we'll probably start to see core inflation come down, and this story from Target today reinforces that. However, overall inflation is going to stay high. It may even head higher from here. So we're going to see these two different statistics developing, which basically means only the rich are going to be able to afford stuff, and the poor are going to be spending everything they earn to just heat their house or cool their house and to buy food and get to work. And I see that, look no further than this natural gas market and this oil market. These prices continue to head higher in energy. And that is by design, folks. Remember, that is by design. The leaders who are in charge in the West are people who campaigned on destroying demand for energy. And how do you destroy demand for energy? You make it so it's so expensive people can't buy it anymore and people can't use it. This is by design, all right? They all take their private jets to that little snowy escape in Switzerland, and they get together and they talk about how you and I need to use less, right? I guess I should stop before I get my channel in trouble again. They're always listening. All right? Remember the big do-over, the fantastic restart, the magnificent mulligan? You know what I'm talking about. That's all about you and I using less energy. These higher energy prices is the direct result of that. Make no mistake, this is on purpose. Team Thanos. All right, moving on. Looks like grain commodities, they're about flat for the day also, so not a whole heck of a lot happening in the commodity space right now. Now, the one story that's driving markets this morning, I think why we're getting this big dip, is this one right here, and this came out just a few hours ago. Target shares fall 8% as it expects squeezed profits from aggressive plan to get rid of unwanted inventory. And let's shrink me a little bit. Now, this story kind of came out of nowhere, but I've had a couple of anecdotal conversations with folks that confirms this on just about every level across the economy. People in unrelated sectors, unrelated parts of the economy, different parts of the country, all saying the same thing. There has been this very rapid inventory build over the last few months. All right. And it kind of came out of nowhere because remember, a few weeks ago, we were talking about how nothing was getting out of China and their ridiculous lockdowns. Well, now we've gone from that to boom, inventory everywhere. People are sending me pictures of TVs lined up 4 or 5 wide off the wall at these big box stores, prices being slashed. Why? Because everything was so bad last year with the supply chain. You couldn't get anything across the pond. Things were getting so bad. We didn't know what was going to happen in China with the lockdowns and what was next. So everybody just panic ordered inventory as much as they could. Well, now that inventory is working its way here, and whoops, now inflation has exploded and people can't afford to buy anything. So these retailers are really, really in dire straits right now. They ordered too much stuff. It's here and their customers can't afford to go shopping. So what do? You have to start slashing prices big time. And I would also caution that a big growth in inventory, all right, when this next GDP number comes out, I'm not sure where it's going to come in at. I know the economy is contracting, right? We are in a recession, any which way about it. But the way the statistics are calculated, inventory growth looks like economic growth in GDP numbers. So this problem may actually disguise itself as economic growth the next time we get a GDP number. And these idiots in charge of our economy are going to pat themselves on the back and congratulate themselves for it when this is a huge problem. This is going to destroy the earnings of these retailers. Remember, the United States is a consumer-driven economy. Anyways, Target said it will take a short-term hit to profits as it cancels orders and marks down unwanted merchandise. The big box retailer wants to clear room for merchandise, including groceries and back-to-school supplies. Back-to-school supplies? My kids are still in school. They're in their last week of school right now. Shut up about back-to-school. Shut up. Don't want to hear it. All right? Summer has not even started. Don't you dare start talking about back to school right now. All right. I digress. Target anticipates its operating margin rate for the second quarter will be around 2%. That's lower than the outlook it gave 3 weeks ago. And what was the outlook it gave 3 weeks ago? This is how big this is, folks. All right? Where was it? I saw it further down here. Here we go. Target anticipates its operating margin rate for the second quarter will be around 2%. That's lower than the outlook it gave less than 3 weeks ago when it anticipated its operating margin rate would be roughly around its first quarter operating margin of 5.3%. Understand just how serious this inflation problem is and just how hurting the American consumer and retail shopper is right now. In 3 weeks, Target's margins have gone from 5.3% to 2%. All right, that is less than half of what they were 3 weeks ago. That's how bad things are for the American consumer right now. People can't afford to shop. And you know what? I just went to fill up gas this weekend, $5 a gallon here in Pennsylvania. $5. All right. A year ago, 2 years ago, that stuff was under $2. What in the world? Again, by design. Team Thanos, the Magnificent Mulligan. This is all on purpose. All right. But look right here. Target, one of the biggest retailers in the country, its profit margins cut in half in a matter of weeks. Marking down inventory. This is a very big problem. And remember, folks, the United States, 70% of our GDP comes from consumer spending. If the consumer stops spending, America's GDP contracts big time. Now, we may get this short-term inventory build from stuff that was ordered last year. It's finally getting here. It may masquerade as economic growth, but that will be a short-term sugar high for the economy, if at all. Our GDP is just going so much lower, just so much lower. And this is going to kill our earnings, folks. This is going to kill company earnings. So this is going to take the S&P down. And that's why stocks are reacting the way they are today. All right. And I see my friend Mike Binder from Robin RC Models. Thank you, Mike, so much for the super chat and your continuing support of the channel. I really appreciate that. He says, equities will continue down while energy and food keeps on going up. When they tap the brake and QE again, the volatility will bankrupt many companies. So I agree, our equities will continue to head lower. As long as food and energy keeps grinding higher, stocks will head lower. Stocks that don't deal in food and energy. Okay, that's important, right? Big box retailers, big tech, anybody but food and energy companies, right? Agriculture stocks should do okay. Food companies should do okay. Grocery stores should do okay. But pretty much everybody else, because people will have no money left to spend after they buy those things. Now, when they tap the brakes and QE again, that statement's a little, what's the word I'm looking for? Oxymoron. QE isn't really tapping the brakes. QE is slamming on the gas or stepping on the gas. Right? QT is tapping the brakes or pumping the brakes. So, but I do believe they will start QE again, Mike. Absolutely. And the volatility will bankrupt many companies. I agree with the volatility. The higher rates is going to bankrupt companies. And remember, what the market likes more than anything is certainty, right? If things are certainly going to be bad, then the markets can plan for bad. But if we have this omnipotent, all-powerful central bank who at any point can just decide we're going to flood the market with liquidity and pass out money from the sky and people will be in the store spending it, companies have no way to plan for that. They can't forecast that. It's not supposed to work that way. That's why I always say hashtag end the Fed. Should have done a long time ago. We went 130, 140 years in this country without a central bank. We don't need one, folks. Things worked just fine before we had a central bank. But thank you very much, Mike. I appreciate the super chat, sir. I appreciate the support of the channel, as always. All right, we are now 2 minutes away from open. Let's just take one last look at the futures before we open. S&P down 40 or 0.9%. NASDAQ down, come on, refresh my window, 161 or 1.28%. And what we got from the Dow down 287 or 200 or 0.87%. Now, I was looking today at this chart here. This is the chart of the S&P 500. And I was trying to see what did the technicals show. Now, full disclosure, I am not an expert at technical analysis, all right? I'm still learning this stuff. I learn a little bit every day. I learn a lot from you guys and the charts that you sent me. But take a look at what is going on in the S&P here. In particular, the relative strength index down here. And this is on a daily candle. I want to take you all the way back here to November, which is, if you remember, that's when the taper started. And I'm just going to kind of draw this little line down here next to the RSI, or relative strength index. That is a measure of the momentum in the stock market. And you see the momentum continues to trend lower highs consistently, even after this recent dead cat bounce that we've had since mid-May. We're butting up against this line, and it looks like the momentum is already starting to head lower. And down here, the MACD is also starting to head lower. Again, these are measures of momentum, all right? That just means that whatever move the market has been making is losing steam. And you can see as the momentum has been rolling over, this dead cat bounce has been stalling. I think we are about to resume lower in markets. I think this trend, let's just put another line here, this big downward channel that we've been in for really the whole better part of the year, I think that's going to continue, folks. We are headed lower. Even though we didn't get anywhere near the upper band here this time, I think it's about time to head lower. Now, that doesn't mean we are going to take a dive today or take a dive tomorrow. Again, these markets are very volatile, and at any minute, they could just march out Lael Brainerd to give an interview and say something lovey-dovey, and the markets would rocket higher. So, take that with a grain of salt. Just showing what I see in the technicals here, it looks like the S&P wants to head lower, and I'd also add that we are still below the 50-day moving average. We didn't even get close to it, but we've certainly bumped into some resistance here right around this previous support line. Down here, support becomes resistance. We have failed to break above that. Maybe we challenge that one or two more times. I don't know. Or we could just be heading straight down from here. So just something I wanted to keep an eye on. And while we're here, folks, I just want to mention I got a couple of events coming up this week. On Friday morning, I'm going to be live streaming the CPI release. Now, that is Friday morning at 8:15 because the CPI number comes out at 8:30. I'll also be doing my weekly live stream on Friday. So I'll be doing 2 live streams on Friday. It's going to be an exhausting day. And tomorrow at 7 p.m. is going to be my Patreon-only Zoom meeting. Again, actually 7 p.m. this time. Last week I messed up the time schedule. But it doesn't take away from the channel. That's just something extra I do for the people who support me on Patreon. I do a Zoom meeting once a week with them. I just did it for the first time last week. Had some technical issues. We're working through those, and it worked a little bit better now. So I look forward to seeing you guys. Thank you very much to all my Patreon supporters that are out there. And if you feel so inclined, there is a link in the description down below if you want to check that out. And moving on, let's take a look at energy markets right now, because I have been watching oil pretty closely. Now, I drew this flag pattern a couple of weeks ago, I guess a couple of months ago now. Really, I've been following this all year. And if you remember when I first drew this pattern, I don't remember, it was a couple of months ago on a stream, I said we were going to break out of this channel, we were going to back test, and we were going to head higher. And wouldn't you know it, that's pretty much exactly what we did. See, we bounced around in this channel, we broke out, we back tested, and now we're moving higher. All right, we are now out of that pattern, so we are going to retire these lines and just kind of take a look at where we're heading from here, above the 50-day moving average, consistently above. And I just want to again point out this line here, a little bit of a declining pattern in the RSI. All right, so when you see a pattern of lower highs in the RSI, that's a little concerning. But if you go down to the weekly chart, it tells a slightly different story. The RSI is actually trending a little bit upward here, kind of in an upward channel this way. So I like oil from here. I don't see a lot of bearish case for oil right now. And the other thing I would point out is the one thing that could work against oil right now. What we have going on is this break between oil prices and fuel prices. Oil is the stuff that goes into our fuel, that we make our fuel out of, but it has to get through a refinery first. And our refineries are struggling to keep up with demand right now. I'm worried we could get into a point where we see gasoline and diesel prices absolutely skyrocketing, but oil doesn't move because the refineries can't keep up. Right? And if we get into a situation like that, that could be something like we see like with the cattle ranchers, where the price of beef is going through the roof, but it's because you can't get the cows through the meat packers fast enough. So the supermarket is raising their prices, but the cattle rancher isn't making any more money. Or the same thing we saw during the lumber shortage when lumber prices went through the roof. The tree growers couldn't get their wood processed through the sawmills fast enough, so the tree growers didn't make any more money. So keep an eye on this deviation between fuel prices and oil prices. It's a little worrisome. I've never really seen anything like that happen before. But in the meantime, the oil chart looks pretty good. And again, I just don't see any other bearish case for oil. Saudi Arabia says they're going to pump extra to make up for the output from Russia that is supposedly coming off of the market because of the sanctions. Well, guess what? Saudi Arabia is also saying in other interviews on other channels that because of the lack of investment in the oil and gas space for the last few years, that they can't increase their output. So Saudi Arabia is kind of talking out of both sides of their mouth right now. And we're just heading into this summer driving season. I think we're probably headed to all-time highs in oil this year, and that would be somewhere around $140, $150 a barrel. I mean, all the way back. We have to go to a monthly chart to get to the all-time highs. What was the all-time high in oil? It was 143. Is that what it was? So I think we're probably heading back there. And the only thing that's going to stop that, like I said, is going to be some kind of widespread demand destruction caused by this inflation or an economic collapse, or if we see, the situation in the refineries, if we get another refinery explosion or another plant goes up and we just can't process the oil fast enough, that could also send oil prices lower, but you won't get any relief at the pump from that. Now, a couple of ways I've been investing in this trend all year. This is one I hold right now, is Devon Energy, ticker DVN, and I own call options in this one. This one has done really well. Got to send a shout out to Greg Manarino, who turned me on to this one. This has done really well. Another one that I don't currently have a position in, but I'm probably going to open one up again, is this XLF ETF. I had been in this one for most of the year. I had been taking profits as we went up and sold off, trading in this band here. This one keeps doing better than this one. This ETF is made up pretty much 50% of Chevron and ExxonMobil, and then the other 50% is like all the exploration and production companies like ConocoPhillips, Marathon, a lot of those smaller players. So these are made up of stocks. That's important, this ETF. This is not an ETF that invests in oil futures. So it is possible that even if oil heads higher, if we get some kind of widespread mayhem in markets, it could drag this ETF lower, even though the oil commodity heads higher. That's just something to be aware of. Although so far this year, even as stocks have sold off, this one has continued to grind higher. So I wouldn't worry too much about that one. Now, another stock I've been following a lot this year has been Schener Energy, ticker LNG. This one buys natural gas here in the United States. It super cools it, liquefies it, and puts it on a boat, sails it across the pond to Europe or Asia, where they regasify it and sell it into the higher value markets there. Now, this company has been making money hand over fist this year, especially off of these European natural gas prices, which have gone up. However, I sold out of this one a little while ago, and I've been looking for an opportunity to get back in, but I'm starting to see market conditions that are really threatening this one. Now, first of all, the double top that I drew here, I drew this a couple of weeks ago. That worries me. That is a very bearish indicator. When you see a double top like that, that tends to be a reversal pattern, and that means this uptrend that we've been in since the fall could have broken down and failed now. Now, another thing I'm worried about, we're holding the 50-day moving average right now. We broke below it, and then we retested and broke back above, but we're right around that 50-day moving average. We could break down below that. Now, here's the thing. This company makes its money based on the difference between European natural gas prices and U.S. natural gas prices. Now, I realize what the geopolitical situation is with LNG, and that, Europe doesn't really have a lot of light at the end of the tunnel when it comes to its natural gas market, at least not politically. But here is the Dutch TTF natural gas price. This is the benchmark for European natural gas prices. And if you take away this huge spike that we had in March when the invasion began, you can see these prices have been trending down steadily since, right? They're grinding lower. This is what LNG sells their liquefied natural gas for. And then look at what U.S. prices have done during that same time frame. U.S. prices have been grinding steadily higher. They've almost tripled, right? So U.S. prices going higher, European prices going lower. That is the profit margins of Schener Energy getting squeezed. Now, those profit margins right now are way, way bigger than they were last year, but they're starting to contract. Remember, the markets are always forward-looking. So it's something to keep an eye on if you're invested in this Schener company. Keep an eye on these prices. If you keep seeing U.S. prices head higher and European prices come lower, then you're going to want to take profits in this one. Just keep an eye on that one. And full disclosure, I do not have any position in LNG right now. I sold mine a couple of weeks ago. I sold too low, but I did sell it. And there is my man, Mark the Stump Grinder, in the Super Chats. Thank you, Mark, so much for your Super Chat and your support of the channel. I appreciate that, brother. He doesn't send any chat. He just sends a Super Chat with no message. Thank you, Mark. I really appreciate that very much, sir. All right. Markets are now open. It is 9:39. Let's see where we're at. Not the futures. Give me the actual indexes. The indexes are down 29. That's the S&P, or 0.71%. The Dow is down 219, or 0.67%. NASDAQ is down 106, or 0.88%. So it looks like they got a little bit of a bounce right at the open, but still deep in the red for the day. We'll see how that one develops today. Oil down about 18 cents, pretty much flat for the day. Gold up $4, flat for the day. Silver down 12 cents. And the 10-year yield still clinging above that 3% mark at 3.005. We'll keep an eye on that. Bitcoin at 29,595, down 5.6%. The volatility in Bitcoin continues. And look at that 5-year chart. That is an ugly chart in Bitcoin. Speaking of a double top, boy, we got one right there, didn't we? You saw my video over the weekend. I know some of you folks saw that one. Crypto winter is here. I do not expect any good news from cryptocurrency markets really until the middle of 2024. That's when the next Bitcoin halving is. So that is great news for Bitcoin investors, because if you are an investor in Bitcoin, if you're not one who buys in FOMO rallies, then this is good, because this means you have 2 years to accumulate Bitcoin at low prices before the next big rally starts. All right, so use these 2 years wisely. Do not invest money that you need in the next 2 years. Full disclosure, not a financial advisor, not financial advice. Do your own research, your own DD, arrive at a decision right for you based on your unique situation. But this is the time to buy Bitcoin. When Bitcoin is down in the doldrums, when it's trading low for 2 years, the time to buy Bitcoin is not when it's up here at 60,000. All right. Fortunes are made during crypto winter, not during FOMO rallies. Remember that. When everybody is saying it's a scam, dump it, get out of it, that's your indicator that you should be getting in. All right. Not when everybody says it's going to the moon and I'm going to get rich on Bitcoin. That's not when you're supposed to pile in. Again, my strategy for Bitcoin has always been to take small nibbles. I use an app called Swan. There is an affiliate link down in the description below if you want to check that out. Full disclosure, affiliate link. But I buy a little bit every week. I don't look at price. I don't care. This is a long-term 10-year plus trend. I plan to buy a little bit every week for the rest of this decade, because I think at the end of this decade, Bitcoin will be over $1 million. And that is 2 halving cycles from now. Go back 2 halving cycles and look what Bitcoin price was, and look at the multiples that it has leaped every time, and then add 2 more cycles of that. That $1 million number doesn't sound so ridiculous when you apply the math of the previous few cycles. It's actually very conservative. All right. But enough about the crypto, or at least about this Bitcoin. Oh, hey, Brian Zarb. Thank you, brother. I appreciate the super chat. Check out Brian Zarb at thetechnicalchartist.com, by the way, folks. Speaking of learning a lot about technical analysis from you guys, Brian Zarb is a fantastic TA expert. Check out his website. I didn't put a link in the description below, but Brian has made a couple of appearances on this channel, thetechnicalchartist.com. Check that one out, because I think there are good things coming from that website. Brian says Japan GDP numbers today. Will we see 2 consecutive negative readings? By the way, XOM just hit 100. All right. Now, I haven't followed Japan all that closely, Brian, but I do know that inflation is finally catching up with Japan. And Japan, like the U.S., consumer-driven economy. So inflation, consumer-driven economy, that's a bad mix. And on top of that, Japan does not have the natural resources or the commodity industries that the United States has. So at least, like, the U.S. benefits a little bit from inflation because we grow a lot of food, we produce a lot of energy in the States. Japan doesn't have that. So inflation will hit the Japanese economy twice as hard as it would hit the U.S. economy. And finally, everybody who's been watching Japan's QE for decades and saying, how come Japan doesn't have any inflation? Well, you got your answer. Japan does have inflation. It just took a while to get here. So yes, I do think we see 2 consecutive negative readings in Japan, and the markets will not like that. I'm not sure what time that report comes out, but thanks, Brian, for that heads up. That is an important data point. I might have to do a video on that one. We'll see. Thanks, brother, and thank you again for the super chat and the support of the channel. And check out ExxonMobil, like you said, over 100 right now, 101.36, up 2.5% today. Check out the year ExxonMobil has had. My goodness. And remember that XLF ETF that I mentioned earlier, which, full disclosure, I don't have a position in that at the moment. That one is made up of about 25% ExxonMobil, so the chart will look very similar. This one has just had a fantastic year. Going all the way back to the max, it looks like we are at all-time highs for ExxonMobil, and I think we're heading higher. So thanks again, Brian, for the super chat. I appreciate that, brother. And there's one more story I want to talk about, folks, before we go. There's 2 more stories. This one, we were just talking about Bitcoin. Explain this one to me. Speaking of the magnificent mulligan and the big do-over and the amazing restart, ask yourself this. Why was the Ripple CEO in Davos? Why? Why was he there meeting finance ministers and bank CEOs? What would Ripple have to do with this gaggle of global elitist supervillains sitting there plotting to make you and I poor? Could it be that Ripple is the platform that they are hoping to build their programmable money, their CBDCs off of? Is that why Ripple was in Davos meeting with all these freaking wannabe bond villains? Careful of these guys. Ripple goes against everything cryptocurrency stands for. If they are in Davos meeting with those people, keep in mind, this is the anti-Bitcoin. Bitcoin is about giving these people less power. Bitcoin is about giving people control over their own money, not central bankers, not money printers, not government interventionistas. It's about giving people the control of their own money, something the government can't touch. What Ripple is doing, what they're trying to do, and what the world is trying to do with Ripple is not Bitcoin. CBDCs are not Bitcoin. I suspect that is what they're trying to do there. They're trying to use it to build their CBDC platform. Don't let them do it. Don't play. When they come out with their programmable money and they try to draw you in with stimmies, don't play. Take their stimmies and dump it and buy yourself some gold or silver and get out of their stupid system, because they will use that money to control your life. They will program it so you can only buy so much food and only buy so much fuel, and they will program it so they can buy as much as they want at lower prices. It will be you and I who has to use less. Do not let Team Thanos get their programmable money into your wallets, folks. And lastly, I want to talk about this one. Hedge fund Elliott sues the LME for $456 million over the nickel trading halt. Not enough. If you ask me, they should be suing them for more than $456 million. But this is an important one to watch. It's going to take a long time. Legal cases move at a snail's pace. Nothing happens fast. This story just came out yesterday. But somebody had to sue the LME for what they did. All right. If you're not familiar with the nickel trade, this Chinese guy who makes everybody call him Big Shot, he was massively short nickel. He owed 50,000 tons of nickel. And then the price of nickel all of a sudden doubled in a couple of minutes, and this guy was underwater by $1 billion. And as the expression goes, when you owe the bank $1 million, you have a problem. But when you owe the bank $1 billion, the bank has a problem. So when Mr. Chinese Big Shot said, I can't pay the $1 billion, instead of just liquidating him and taking the loss, which the loss would have gone to JP Morgan because they underwrote those shorts, no, they turned off the market and they canceled trades. All right. And this trend of canceling trades, watch out for that, folks. That is a dangerous precedent when the big guys can say, we lost money, changed our mind, do over, and they just get rid of the trades and delete them and give you back your cost basis, but take all your profits. You cannot allow that precedent. That cannot be allowed to take root in the financial system, that the banks can just do that anytime. So this case must go forward. They need to pay out the wazoo, make them pay every penny of that $456 million, double it, make it $1 billion. They deserve to lose everything. The LME should go bankrupt. They should lose 100% of everything they have as a message to the next schmuck who tries this to anybody, because they stole over $1 billion from retail traders when they did this. Why? Because JP Morgan's not allowed to lose money. All right, this is just another in this long line of things, like the taking away of the buy button with AMC and GameStop, like the rigging of margin requirements and the changing of the SLV prospectus during Silver Squeeze, right? They changed the rules so they can't lose money. This is now the third time in a year and a half that they have done something like this on such a grand scale. It's got to stop. This case, keep an eye on it. And if you lost money in this, join this case, man. Pile on. Sue them for everything they have. Take them for everything they got. I don't know. I just remember really grinding my molars when I read about this one. And Mr. Woolali, thank you, sir, for your super chat. I appreciate it very much. He says, in the past, the debt to GDP ratio has stayed fixed for weeks or even months without any change. In the last few weeks, it's been increasing 0.01% daily. I find that very concerning. What do you think? I haven't actually seen that, Woolali. The debt to GDP ratio, I've seen it reported different ways depending where you get it. There's these quarterly snapshots that come out because GDP changes quarterly. They release those numbers. But the debt is always increasing. So I think it depends on where you're looking, that it would be increasing by, a fraction of a percent daily. I don't know. I haven't noticed that trend. I honestly, I have to look into that one. I haven't seen it. But I have seen that you can get wildly different estimates for debt to GDP ratio depending on where you look. You can go to Y charts and get one thing. You can go to Statista and get another. You can go to the U.S. debt clock and get another. So there are a lot of different ways that it's reported. I have been using the Statista one. Let's see what that one has at debt to GDP ratio. Let's see if that one has changed. That one is still relatively unchanged. Well, I'm not going to get into that right now. I'm going to have to keep an eye on that one. But thank you, Wally, very much. I appreciate the super chat, sir. I am alarmed at the increasing trend of debt to GDP, not necessarily the way the reporting is going, as you're mentioning in your super chat, but overall debt to GDP, that's a big one. That's why I included that in the modified Manarino market risk indicator, which we haven't looked at that in a while. That one is showing it at 129, but I think we're probably headed considerably higher in that. Currently, the 3 MRI is at 245. That's creeping back up. I remember we pegged the scale. We were over 250 a couple of weeks ago on this indicator. We're going to need a bigger pressure gauge, apparently. But again, Wally, thank you very much. I appreciate the super chat. Guys, I appreciate the support of the channel so much. Thank you very much. All you guys who are sending your super chats, all you guys who support me on Patreon, thank you. I appreciate it. Reminder, I have my Patreon-only Zoom meeting is tomorrow. If you want to check that out, there is a link to my Patreon down below. Does not take away from the channel in any way. It is just a more personal face-to-face. It's a smaller group, so it gives you guys a little bit more access. It's a little easier to interact directly. One last trip through the indexes, shall we, before we wrap up? Looks like the S&P is rallying right now, still down almost 14 points or 1/3%, but well up off its lows from this morning. The Dow's doing the same, although not as much, down 0.5% or 160 points. Uh-oh. NASDAQ is leading the way higher, still down, but the NASDAQ is down the least, now down 34 points. Is it going to be one of those days? Is this going to be one of those risk-on nonsense days? Right now, it's looking like it. I don't know why we see the NASDAQ rallying like that, especially not after that target warning. And the 10-year Treasury is still clinging above 3%, just barely. Folks, markets look like they want to go risk on today. I don't get it, but hey, whatever. Onward, upward. Let's go make new highs. Why not? Anyways, guys, I want to thank you very much for watching this morning. I want you to have an awesome, awesome day. Thanks again for all your super chats. Thank you to my Patreons. And I think we're going to call it there. It's 9:53. I have been running my mouth for long enough. I will see you guys next time. Till then, live small and dream big.